and welcome back to our continued discussion of Chapter 2. In this video, I'm going to just wrap up some final points for Chapter 2 that we need to go over. And then in a final Chapter 2 lecture video, I'll be going over some transactions that will help us put together some of these contacts in practice. Okay, so jumping off of what we talked about in the prior video, which was financial statements, the three primary financial statements, one important concept that we want to make sure to go over is that of financial statement articulation. Okay? So when we think of articulation or of being articulate, for a lot of us, the same definition might come to mind. If someone's articulate, they might speak well. Or someone asks you to articulate your words, they're asking you to be clear about that which you're saying, for example, right? But when it comes to accounting, when we're talking about articulation, articulation has a different definition and different connotation. When we're talking about financial statement articulation, we're talking about how all of those financial statements are connected, okay? So it's basically how the financial statements are connected. Our balance sheet, our income statement, and the statement of cash flows, all of these are connected with one another. Okay? What would be an example of that? So with the statement of cash flows, for example, we have a beginning cash balance, and then we show how that cash balance changed over the period of time. So we are left with an ending cash balance. Where do you think that ending cash balance needs to show up? It needs to show up as our first asset on the balance sheet, under the asset category. Okay, those two financial statements in that sense are connected. And another reason why these three statements and also the other statements, but these primary statements articulate with one another is because the information that we use to set up these three statements, they all come from the same source essentially, right? We take all this information, we organize it based on where it needs to go, but all that information is connected at the end of the day. Another example would be the income statement, for example. At the end of the day, our bottom line tells us what our net income is. What we'll learn about later on is net income. It has an effect on an account called retained earnings. And guess what? Where does retained earnings show up? It is a balance sheet account. Okay? Same with the expenses. Because net income is basically your revenues minus expenses. So net income overall impacts retained earnings, but revenues and expenses on their own also impact retained earnings, which show up on our balance sheet. Okay, so when I ask you about financial statement articulation, what that actually is, the answer should be, it refers to how all our financial statements are connected with one another. They aren't, none of these financial statements stand on their own lonely island by themselves. The information used to set up these statements all come from the same source, and they're all connected. The only difference is each of these financial statements tell their own story for a different period of time. The balance sheet gives us a point in time on a specific date for the end of a period, where the income statement and the statement of cash flows shows us some economic activity over a period of time. Okay, so that's the main idea behind financial statement articulation. Now, one thing we want to at least briefly go over is forms of business organization. Because there are different types of business forms. Okay, so the first form is what we call a sole proprietorship. Okay, a sole proprietorship, it's a business that is owned by one person, hence the word sole in the name for sole proprietorship. It's owned by one person. Okay, and often with this kind of business, the owner is also the manager, because these tend to be really small businesses. This type of business setup is really common for really small retail stores, some service businesses, law practices, medicine, accounting, so on and so forth. This is in our economy at least, this is the most common form of business organization. And why do you think it might be the most common? Because it's the simplest to set up, right? All you need really is a business license that you get at the county office, and you can go ahead with organizing your business. So this is the most common because there's the least amount of organization and paperwork that needs to be filled out in comparison to the other forms of business. Okay, but what's one negative aspect? No, not necessarily negative, but what's one thing to think about with a sole proprietorship? One thing to think about is that as the owner, you assume full liability for the business's debts. So just as you are the receiver of the business's revenues, you assume full liability for the business's debts. And that liability is unlimited if you are a sole proprietor. Okay? So if you're sued, if there's a lawsuit against your company, who gets sued or who is going to carry the brunt of any damages? Who's going to have to pay any damages arising from the lawsuit? The owner. It's not the business being sued, it's the owner being sued, because this kind of business is not a separate entity on its own. Okay, so although it's the most common, it's the easiest to set up, and the owner basically has full reign, right? They often act as the manager. One con about this is that this kind of business setup, the owner assumes full liability for any and all debts that the company might have, and any, for example, lawsuits or legal things that might happen down the line. Now, another form of business organization is that of a partnership. Okay, so this is still an unincorporated business, just like sole proprietorship is. It's not a corporation. But the difference between this and a sole proprietorship is that it's owned by two or more people at a time, hence the name partnership. So two or more. And these people voluntarily act as partners or co-owners of a partnership. This is common for to be used for things like CPA firms and law firms, as well, or professional practices like medicine. So sole proprietorships and partnerships are common forms of business for those kinds of professions. So that's often why you think, well, there's unlimited liability when it comes to these forms of business. How would a doctor or a lawyer deal with that? And that's where, malpractice insurance comes in, and various forms of insurance come in to cover, costs of lawsuits or negative situations that might arise down the line if someone decided to sue the owners, or at least one partner within the business, right? Or the sole proprietor if it's a sole proprietorship. Okay, so just like a sole proprietor is responsible for all the debts of the business, so are all the owners within a partnership. Okay, they are personally liable, just as if it were to be their business on their own. Okay, for all debts. They're personally liable for all debts. Okay, so from a legal standpoint, a partnership is not a entity on its own. It's not regarded as an entity to exist separate from its owners, like like a corporation does, right? But from an accounting standpoint, a partnership is going to be viewed as a separate business entity, where we keep the affairs of the business separate from the affairs of the owners. Okay, so a partnership does also have some liability issues when it comes to the owners. So if something happens and the partnership has to pay back a huge debt, the owners then are liable for that, not the business on its own. Okay, so there's not enough money in the business to pay down a debt. They're going to go looking to the owner's personal funds to satisfy any and all debts. Okay, and then finally, what about corporations? Okay, the difference about a corporation versus other forms of business is that corporations are seen under the law from a legal standpoint. Okay, they are seen as an entity separate from its owners. So basically, a corporation, you can think of it from a legal standpoint, it's seen as a person. So if a business is organized as a corporation, it's not the owners that get dragged to court if there's a lawsuit. It's the business itself that is dragged to court. Might be a strange concept for some, but that's really how it is. So if you have a corporation, if you have business XYZ, and it's a corporation, and something goes wrong and the business gets sued, you as the owner are not going to be dragged to court. It's the corporation, although you can't necessarily physically touch the corporation, it's really just a concept. That corporation is seen as an entity on its own, so it's the corporation that gets sued in that situation. Okay, but it's not all bad. I'm just using that as an example to illustrate the concept that these corporations are seen as entities on their own. Because of that, the nice thing is that with a corporation, let me rewrite that, its owners are not, okay, owners are not personally liable for the business's debts. Okay, so if there are any debts that need to be paid, it's not, the owners aren't going to be financially at risk in terms of their own personal finances. The business itself is liable for its own debts, but its owners are not personally liable. Okay, for that reason, what do owners risk? Owners only risk the amount they originally invested. Okay. This is what we call limited liability as opposed to unlimited liability as with the other forms of business organization. If you are a corporation, the owners, the only thing they stand to lose if something goes wrong is the amount they put into the business at the beginning when they bought shares. So that's really all it's limited to. They can't lose anything beyond that. Okay, and the ownership of a corporation is broken up into shares of stock in the business. So if you have a business that is going public, the owners are who we refer to as the shareholders of the business, right? So with a corporation, that corporation is basically broken up into shares of stock, okay? And if you decide to buy one stock of a corporate business, then you become an owner, whether it's one share or 1,000 shares. Just owning one share or even a fractional share makes you an owner in that business. Okay, so owners of corporations are referred to as stockholders or shareholders. Okay, and an example would be Google. Okay, so if I decide to buy a Google share, I'm an owner of Google, although it's probably a very, 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 very small percentage if I only have one share. I'm now an owner of Google stock and a partial owner of the business. But once I have that Google share, I can decide to sell that to someone else. There's no rule that says I can't. Then I can freely buy and sell shares as I please at any time. Okay, so although sole proprietorships are the most common form of business organization, corporations tend to be the most dominant just because of the dollar volume of its business activity. Okay, so the nice thing about corporations is it's limited liability, but also the downside of a corporation would refer to what we would call double taxation. We're not going to get too deep into that, but I'll mention that briefly here. So this double taxation is one downside of the corporate form of business. So what does that mean? Well, the corporation itself, its earnings are taxed. Okay, so it's taxed based on its taxable earnings. Okay, but then those earnings, depending on the financial situation of the corporation, earnings are then often paid out as dividends to owners of that business, shareholders. Well, these dividends that these shareholders receive count as income personally to them. And guess what? Those dividends then, those earnings, are taxed as well. So not only is the corporation's earnings taxed at one point, right? But when those earnings are then distributed to owners, those dividends are taxed as well. So that's where the term double taxation comes from. Okay, so that's what some people might say is one downside of the corporate form of business. For our purposes, a lot of our focus will be on corporations. It's not to say none of our problems will be from the perspective of a private business. It can be, but a lot of the problems that we'll be working on will assume the corporate form of business. Okay. When we talked about the balance sheet, remember it's broken up between assets, liabilities, and owner's equity. So remember, owner's equity, if it's a corporation, tends to be broken up between retained earnings and capital stock. That is if it is a corporation. Okay, so how we show ownership or equity in a business is going to look slightly different on the balance sheet depending on what kind of business it is. Okay, so if it's a corporation, under owner's equity will be broken up between capital stock and retained earnings. Okay, capital stock is the amount of money that has been invested into the business by owners, and then retained earnings is the cumulative amount of earnings that have been kept within the business. Okay. Now, what about if we're looking at a partnership? With a partnership, equity, remember we said that a partnership is owned by two or more people. So let's assume it's owned by two people in this situation. Where is the money coming from to finance a partnership if there's only two owners, and that's the only source of income or source of capital? The startup money is coming from these two owners, right? The money that they're deciding to put into the business. So in that case, equity is broken up just between the capital of the two owners, or two or more owners, however many there are. So for example, if you have Bob Smith as one owner, you'll put Bob Smith, comma, capital, and let's say Bob put in $1,000. But then if you have Sandersmith, let's say it's maybe a married couple that owns the business. Let's say she put in $3,000. This is how we would show equity in a partnership. But if it's a sole proprietorship, remember that's where only one person is the owner. And to show equity in that case, let's say if Bob Smith is the sole owner of that business, all you do is you write Bob Smith, comma, capital, and you simply write how much money has been put into the business by Bob Smith, less any withdrawals, okay? So that's basically how the setup is going to look different. But this is the setup we'll be focusing on for the purposes of this class. If you've taken Accounting 101, you're probably familiar with these two kinds of setups when it comes to illustrating equity on the balance sheet. Okay? And we're almost done, so I just have a couple of concepts to go over. Two of those being liquidity and profitability. Okay? What is liquidity? Does it refer to how much something resembles water? Not quite. Okay. Something in accounting, when we talk about something being liquid or not, okay, it refers to something entirely different. Okay. If we're talking about a business's liquidity, okay, that refers to the business's ability to pay its debts as they come due. Okay, so liquidity is the ability of a business to pay its debts as they come due. Okay, so if a business is highly liquid, what does that mean? That means that as debts become due, as those due dates come knocking on their door, they're able to satisfy those debts and pay them off. Whereas if a business is not very liquid, then it struggles to pay its debts. Okay, this is very important if a business is going to survive. If a business is constantly struggling to pay its debts, eventually what do you think is going to be the end result of that? It's easy for a business to go bankrupt in that sense. Okay, because its creditors are eventually not going to become very happy if they keep waiting and waiting and waiting for their debts to be paid, and they're not paid. They're going to come for the business's assets as payment for those financial obligations. How is profitability different? Liquidity, again, if liquidity is refers to the ability of a business to pay its debts as they come due, profitability refers to a company's ability to generate net income. Okay? So this refers to a company's ability to generate net income. Okay? So remember our income statement where it's revenues minus expenses? If a business is profitable, it's able to generate more revenues than it is generating expenses. As long as revenues are higher than expenses, you have something called a net income. However, if your expenses are higher than your revenues, that's what we would refer to as a net loss. If you're constantly operating at a loss, you're not very profitable. You're the opposite of that. Okay, so that's the difference between liquidity and profitability, and that'll definitely come up later on as we move through this course. There's also an important concept to go over is the concept of adequate disclosure. What exactly does that refer to? Adequate disclosure basically means that those external users of financial statements and financial information are informed of everything that they possibly need to be informed about in order to make good decisions. So when you think of adequate disclosure, think of our external users. If we're thinking from the perspective of a business, our external users have any and all information that they possibly could need to have in order to properly interpret those financial statements. Okay? So we can think of it as external users are informed of all necessary info to properly interpret our financial statements and make decisions off of those and off of that information. Okay? So financial statements have disclosures attached to them. Sometimes you'll see a disclosure at the foot of a financial statement, or oftentimes there's a whole section in the financial report or the annual report where you have all the disclosures that these users might. So in the notes accompanying the financial statements, usually at the end is where you'll have all these disclosures. So again, these disclosures will show up in the notes, but they can also show up either at the foot of a financial statement or as part of a financial statement. But remember we said before, financial statements are one thing, right? Balance sheet, income statement, statement of cash flows. And these statements are one thing. If you are knowledgeable about accounting, you can maybe at least read what's going on there. But oftentimes, this information needs clarification or explanation, even if you're a seasoned expert, to have a better understanding about what's going on. So that's why these disclosures and these notes are necessary. Your statements might be a couple of pages long, but it's very common for the notes, where all these disclosures are, to be a lot longer than the statements themselves. So some examples of disclosures that you might have to make is maybe what if there's an unsettled lawsuit with the company, right? That might impact my interpretation of what's going on here. Subsequent events. Maybe there was a merger, right? Or the company is thinking of downsizing. Some significant accounting policies that the company has adopted. Okay? If there's contractual commitments, or from a creditor's perspective, I would want to know if there's not already assets pledged as collateral, or if I'm a potential investor, I want to know if all these nice assets I see on the balance sheet, if a majority of them are pledged up as collateral, I might want to decide whether that's a good thing or a bad thing and take it with a grain of salt, right? Think of it within context. Okay? And why is all of that important? Why would creditors care about financial statements? Why are they interested? Well, if you're a creditor, for example, a bank, you're more likely to give a business a loan if you have a good reason to believe that you're going to get your money paid back to you plus interest, right? What does that remind us of? If I look at these financial statements and I see that this business is highly liquid, I'm going to be more inclined to extend credit to this business. But if the opposite is true, I might be more apprehensive. If I see the business has also been very profitable, that might also make me more comfortable with extending credit to a business. But as a creditor, I'm really more concerned about its liquidity. I'm also concerned if I'm looking at the balance sheet, does the business have more assets versus liabilities, right? Are the assets larger than its liabilities? What if it's the other way around? Okay. And it's important for creditors and investors to look at these financial statements in order to make those judgments. But often, well, not often, but this is something that needs to be considered, is the concept of window dressing. Management knows that creditors, if they're looking to get money from the bank, they know that these creditors are going to be looking at the financial statements. So window dressing is the unfortunate situation where management makes these financial statements look nicer than they actually are, right? Move things around, make things look a little bit better than they actually are to increase the chances of actually getting the outcome that they want. For example, a creditor extending a loan to a company. Okay, so window dressing is where management tries to make these statements to look as strong as they possibly can. Okay, so that is our continued discussion for Chapter 2. Look for a final third video where I will be going through the transactions that you see in the Chapter 2 PowerPoint, and I'll be going through those step by step with all of you.